Okay, so in this video we're going to take a look at an important term used by investors and analysts as a way of capturing the value of a company. It's called enterprise value, and it's useful for certain key ratios such as the enterprise value to EBITDA ratio. But what is enterprise value in its own right? Well, it's an attempt to put a value on a firm from a certain perspective. So, how would you value a firm? There are two possibilities, you could say. One is add up all of its assets line by line, buildings, equipment, motor vehicles, and so on. Each one has a market value, add that up, you've got some kind of valuation. But that sounds like quite hard work. Why not look at how those assets have been paid for instead? And that's what enterprise value does. It says every one of those assets must have been paid for by either a shareholder putting money in, a bank lending money. They can't have been conjured out of thin air. And actually the quicker way to value a firm, therefore, is to look at the funding that's come in rather than the myriad of assets that might have been used or bought. A bit like Christmas presents, if you like. You could ask me, Tim, what have you spent on Christmas shopping so far this year? And I could list one by one every single thing I've bought and a market price when I bought it. Or alternatively, I might just say, actually, you know what? I did all my Christmas shopping after one visit to the cash point. I took out £250. I've got 150 left in my pocket, so the answer is £100. And unless you want an individual list of items, that's the answer. So, enterprise value takes that approach. It says we should be able to work out the value of a company by looking at how it's been paid for in terms of its assets, rather than necessarily going through them one by one and adding them all up. So, what are the ingredients? Okay, who pays for the assets of a business like Tesco? And the answer is either shareholders or banks. Those are the two main sources of funding. Tesco also makes its own profits, but it needs external help in the form of what are called shareholders and also lenders. So enterprise value starts there and says what we ought to be able to do is look at a firm's market capitalization. That's the number of shares in issue times a recent or current share price. That's a good starting point. That tells us the value of the equity contribution from shareholders. And then we want to add on to that the contribution of banks and lenders, known as net debt. And if we add those two together, we'll come up with the total enterprise value. So how does that work? Well, we could do this for, say, Tesco. The last time it reported a full set of 12-month results, that was February 2010, so the next full set due out just after the new year. And we could say, right, what was Tesco's market capitalization, say February 2010? It's obviously changed since then, but at February 2010, the number of shares in issue in millions was 7985, that's millions. The share price then was £4.20. And therefore the market capitalization at February 2010 for Tesco was a fairly chunky 33,537, all in millions. Now, net debt. Why net debt? Well, this is long and short-term debt minus cash. So again, the logic here is effectively this. If I said to you, how's your house been paid for? And you said, well, the house is worth 200,000. And I say, well, yeah, but how is it financed? And you say, well, actually, with a loan, a mortgage, and that's also 200,000. I would say your debt is 200,000. Then I ask you if you've got any cash in the bank. And you say, actually, yeah, I've got £10,000 in a savings account. And I say, well, in that case, your net debt as a person is the £200,000 loan on the property minus the £10,000 in the bank. Because although you haven't chosen to do it, you could, in theory, write a cheque to the mortgage company and clear £10,000 of the mortgage. So your net debt, that's your debt adjusted for any cash you've got, is only 190. And that's what Tesco would do too. Companies have cash on their balance sheets, they need it so they can pay suppliers and so on, and that is factored into net debt. So Tesco's net debt, that's long and short term debt at market value, minus any cash sitting around on the balance sheet which could in theory be used to pay it down, even if it hasn't, is again a fairly chunky number, 9140. And that means the enterprise value for Tesco at February 2010 was 42,677 million. So, just to recap, what does that tell me? It says that the market is putting a total value in enterprise value terms on Tesco of 42,677. That's the market value of the contribution of shareholders at the date I've chosen to do the exercise, February 2010, plus the market value of net debt, debt adjusted for cash. An enterprise value can then be applied either to answer the question, what would someone pay if they wanted to buy all of Tesco at its market value, but also it's useful for a ratio, something called enterprise value to EBITDA.